And now it's my pleasure to introduce and bring up to the stage Michael Roberts, the President and CEO of HSBC Bank USA. He was previously 30 years at Citigroup and Global Head of Corporate Banking and Capital Management. Also, HSBC has received numerous awards for their leadership in sustainable finance, and among other things, made a commitment to $100 billion of financing investments by 2025 in clean energy and so on and so forth, and you'll hear more about that. So come on up, Michael. And then I'm also glad to introduce Ignatius, who is the editor-in-chief of Harvard Business Review, former editor at Time and Wall Street Journal. He had 20 years in Asia. And he has made sure, for all of those of you who read HBR, there are countless great articles, and actually the error at the heart of corporate leadership is one which sort of touches on some of these issues that Kip just talked about. And he's got the Future Economy Project, which is also terrific, and been part of our conferences each year. So welcome to both of you, and thank you, and take some extra time since we're running a little late. Okay.
Who's interviewing whom here?
I don't know. We'll see how it goes.
Okay. All right, so we're at the end of the day.
Yeah.
Okay, people are probably flagging a little bit. So we got to be sharp.
That's right.
Witty repartee was probably
Okay.
good and
A
bad.
little bit better.
All right. I don't have any. Do you have some? Because
We'll see.
okay. So yeah, I do want to say, I mean, if people are wondering, what's HSBC doing here? I mean, I don't want to, understate the kind of accolades that HSBC has received in the field of sustainable financing. And I will quote, so Euromoney called you the #1 bank for sustainable finance last year, saying, quote, if there's one bank that realizes the urgency of getting capital working for the planet, it is HSBC. So that's a little context. So maybe to start, and on the topic of context, how do you define sustainable finance? And then we can sort of pick it apart a little bit.
Well, look, I mean, you could always, I don't know if the mic is on. Mic's on. You could define it as it's often defined, it's ESG, it's environmental, it's social, it's governance. I think that almost pigeonholes you into thinking of it. And I would say, to be honest, most sustainable finance really has been environmental to start with, because it's more tangible, people can understand it. But I think it is expanding quite a lot. I think it's doing good for the planet, good for the people, in a way that bankers have never thought. They usually thought about return on investment, usually a project, usually something that they understood. And I think it's really taking the industry and the investment community in a much different direction, which I think is good. It's very healthy.
So, all right, so just to ask, so if you are lending to somebody with a good ESG record, and we can talk about how you determine that, does that mean that borrower will get preferential terms?
I think it's starting to happen. I think for a long time, and take a green bond, you all know what green bonds are, primarily driven for environmental reasons, not uniquely, but primarily. Most issuers did not really receive any sort of discount for doing this, or any sort of benefit, but they issued anyway. I think it's starting to happen, however, in particular, say in the loan market, by banks primarily, who are starting to give pricing concessions. And it's being done really to incent those issuers to issue. But they're quite slight still. And that's okay, because I think you need people to consciously decide they want to invest. It is more expensive usually to invest, because you've got to create a whole infrastructure around any type of ESG type of issuance. But there is a willingness to do that regardless. I think there's a great desire for certainly large issuers and investors to be seen and to be really being much more productive in how they raise financing and what they use those proceeds for.
And does that mean that the bank or the stakeholders are willing to accept a lower return, if that's the case, for financing that meets these sort of strategic objectives?
Starting to. I mean, we have a program.
That's a big deal.
No, look, we have a program, several programs. One, we did a transaction with Walmart, everybody knows Walmart, who came out a couple years ago, actually, and said they wanted to make sure their supply chain was much more focused on environmentally sustainable type of production means. And so they came to us, and we've created a supply chain finance program, which essentially means that the banks, such as ourselves, lend to their suppliers. And we've given them a pricing concession on their adherence and their improvement to in terms of sustainable production. So it's starting to happen, and we've done it, and Walmart has helped us do that. So I think there is a movement towards that. But I think we're just at the tip of the iceberg. But I do think that you'll see it more and more because as rating agencies look at this as part of the way that they look at companies' rating, credit ratings, and we could talk about this more, the bank regulators look at climate and environmental risk as a very important part of how they will assess banks' overall capital structures and their own regulatory strength, let's call it, then I do think you'll start seeing more and more pricing adjustments. And then the investors, and I'm sure there's many out here, will have to also be willing to say, if there's a bond issued and if it's two issuers, two very similar credit ratings, then I'm going to be willing to take a pricing concession on a bond issued on an ESG type of format.
So let's talk about ESG data for a second. I think a year ago when I was here, I lamented the fact that, or the reality that ESG data is inconsistent. Yeah. We do a ranking every year of the 100 best performing CEOs. Yeah. It includes total shareholder return, but also a significant portion that is ESG data. We don't do ourselves. We get from Sustainalytics and others. The others thing, it's interesting because if you get ESG ratings of all these companies from more than one agency, you realize they're looking at the same companies and seeing something very different. Yep. So I think it was Michael Porter and George Serafim at Harvard Business School with Mark Kramer of FSG wrote recently, most sustainability reporting is unreliable, inconsistent, and largely covers factors that are immaterial both to the economic performance of the company and to the company's global impact. So maybe the question is, do you agree with that? But maybe the real question is, where do we stand in measuring what matters?
Yeah, look, I mean, it is new. So, I think we should take that consideration. And I think a lot of companies are just trying to grapple what does that mean. And again, you have ESG, very broad definitions. Again, people tend to be very comfortable with the E part, not too comfortable with the S and Gs. So right there you have to say that needs to be, I think, better defined. I think secondly, people don't know what, certainly those reporting just don't know what to report today. So I do think it is very varied. I think there are certain organizations, we're a member of TCFD, which we can explain to the audience, which has been helpful because we actually issue a very large report every year, which gives a lot of the data that many people like to read, such as our own exposures, our loan exposures to different industries, et cetera. Not everyone is a signatory to that organization, and that organization in and itself is developing. I think over time, it will hopefully be adhered to by many, many more. Some question will be, should certain regulators just, and it could happen as well, mandate that to be part of the reporting process? Should the SEC say there is now going to be a section in all of your various securities reporting that you now have to define what your either exposures are or what your efforts would be? So I do think we're a long way away from that, but it is started as well.
So you hear investors more and more talking about ESG and that being an important part of their investment decision, their portfolio. And then companies complain that, at the end of the day, they're interested in kind of short-term, share returns. How is that dynamic changing, or how can that dynamic change?
I was with a bunch of bank CEOs yesterday. And every one of them said it's interesting because they all have ESG programs. They're very proud of it. They're investing more and more. They're talking about it. And then they get on their quarterly earnings reports, not a question. Never, ever a question whatsoever. It's all about, returns, costs, revenue growth, et cetera, et cetera. So I think the investment community needs to start asking this. And I know there is a large part of the investment community, those in this room today, who do think about it, but it needs to be married to the financial analysis that's being done. And that has not yet started. So I think there is a lot of quarterly reporting. And Kip mentioned it as well. That is a short-termism that we have to deal with. But I do think, as Larry Fink and others have started to publicize, that as the investment community, in particular, the buy side starts to say, we are really very focused on this, and I'm not going to ask you the follow-on question to some financial ratio, which is often how these earning reports or sessions go, and ask you, hey, what about what you have done recently for ESG, whatever domain it may be in. That's going to be a revolutionary day when that happens. And I don't think we're that far away from it, but it hasn't happened. So all of you people who get on those calls, ask the question. the CEOs would actually like to talk about. They really would. They just are never given a chance to do so, and the less time they are able to do so, or the more times they are forced to talk about all of the normal stuff on those calls, which if anybody's ever listened to these calls, after a while they get kind of boring, to be honest. So ask the interesting question. They'll love it, because it allows them to, most CEOs, and I completely agree with what Kip says, are proud of what they're doing. They're just not allowed to ever talk about it, and they want to. They really want to say, you know what, we're not bad. You know, bankers are all not rent seekers. They all, you know, all of us like to say we're doing much better, and those are some of the things that they're most proud of.
So you also hear investors, and I can't remember if this was McKinsey data, but investors saying they'd love to see a legal mandate around sustainability reporting, that it's mandated, that it's standardized. Does HSBC have a view on that?
Look, I don't know if we have a view on it. I mean, we try to do a lot of reporting ourselves. It's very voluntary at this point. I think, you know, like anything legal, once you get into that, like in an SEC document, it'll be another, you know, 50 pages of regulation we'll have to look through. And we have probably 250 pages worth of, you know, documentation we already send over in terms of our 10Qs and such. So I would rather it be voluntary, and I'd rather people be much more open so that we can all get very comfortable with this. As soon as you make it a legal mandate, you'll have lots of lawyers writing something up that none of us will be able to understand, frankly. So I would rather not do that. And I don't think it's going to be, if you make it legal, it's not going to be something that everybody embraces in the company and everybody really necessarily feels good about it.
But the voluntary has been a pretty slow slog.
Yeah, but again, I think it's everybody in this room, all the equity investors start asking about it, demanding to know, it will be a lot quicker. If stock prices are determined in part by the response of the CEO on an earnings call because of sustainability issues, that will get the attention of a lot of people.
So we spend a lot of time at Harvard Business Review trying to figure out, you know, how does one change the world? Yeah. And so on these topics, is it policy? Is it consumer pressure? Is it, you know, finance? Is it? I mean, it's a combination, ideally. But we're talking about finance. You know, how do some of these changes and innovations that are happening on the finance side change the world?
Yeah. Well, look, I think, and I was in Washington the last couple of days, and so I had a lot of opportunity to speak to both policymakers, regulators, et cetera. And this topic kept coming up. And I could tell you one, in the world of Washington, there's a very divided view on this. You know, there are those that say exactly we should do this. We should even have it more mandated, that banks and other financial intermediaries should really take charge, and that they should be highly sensitive to this and really be part of a social evolution. There's another side, and you can imagine which side I'm talking about, who says exactly the opposite. Absolutely no way should a bank or a financial intermediary be forced in any type of intervention in a social evolutionary process. So right there, I can tell you that you know, a lot of banks and, you know, feel kind of put in the middle of it. But to answer your question, I think it's going to come down to what your clients and your customers believe. If they come in and won't do business with you because you, frankly, are not seen as a company that is embracing ESG you know, goals sufficiently, that is very powerful. I think secondly, and having worked at 2 large banks, what your investors think has a paramount importance. And having been in a situation where investors have gotten very, very focused on transactions and activities that they did not want the bank to do, carried a huge amount of weight. And now I do think investors are, in particular the big fund managers, are willing to make those statements. Again, Larry Fink went out with a pretty big letter a couple weeks ago. The European investors in particular have been much more demanding. Some of the big private investors, the sovereign wealth funds, very demanding. That's how you change things.
Well, okay, so play that out. So Larry Fink says, you know, that sustainability is at the center of BlackRock's future investment strategy. What does that mean? How does that play out in a significant way?
Well, look, and I don't know if we have representatives from BlackRock here today, but if he says that and they follow through on it and they've got $6 trillion which way they invest, and they're going to decide, you know what, we're not investing in companies that fall afoul of you know, acceptable ESG type records, and your stock price starts to fall, it gets the attention of the board, the CEO, the management team very, very quickly. And so I think it's very powerful. In fact, I would go back to your earlier question. You can have it regulatorily or legally mandated, or you can have investors telling you what it is. Between the two, you'll have a quicker reaction, frankly, when the investors start selling your stock and you have a significant fall in your stock price. And in particular, if the investors state the reason why. They may say, great company, great earnings, love certain parts of strategy. However, terrible record on ESG-related activities. that will get attention. And no board in the world is going to say, we don't care, doesn't matter. We're going to continue to pollute, we're going to continue to do this, continue to do that. Right now they know their customers don't want it, their shareholders don't want it. Certainly policymakers will come or certainly follow suit. You put all that together, it's a huge amount of pressures.
So there are some banks, investment banks, that have stopped making loans to certain sectors.
Yep.
Arctic drilling,
Yep.
New coal plants.
Yeah.
What's HSBC's position, and do you think these sort of declarations move the needle, or is there something else?
Look, I think we have a similar energy policy as well, and we're very focused on reducing our exposure to those certain industries. It's in our report. You can all go read it online. I don't know what the site is, but it's out there. Look, I think it's too early to tell, because I don't think any bank, for instance, have gotten out completely of all of those sectors. So banks are all reducing their exposure. You don't want to go. You can't get out one day to the next. And you also don't want to cause defaults and other type of issues for yourselves. Secondly, though, that's only a tiny fraction of the role to banks. So if we're going to get out of Arctic drilling, there's a lot of other banks who will get back into it. And then it's also the capital markets. I mean, between the two, the banks are much more sensitive to this because they have shareholders than public investors. So look at the DAPL pipeline, which is for everybody, the Dakota Access Pipeline. It was highly controversial. A lot of banks did drop out, including my old firm. HSBC was never in it. And that transaction got off into the bond market pretty easily. No investor in the bond market said, I'm not going to invest in that. In fact, the transaction was oversubscribed. The banks struggled with this. I think at least 3 or 4 banks dropped out and did not underwrite the final transaction, which took it to the bond market. And that tells you that there's much greater sensitivity by the banking community because of the pressure by shareholders, because they are public companies, and they have to watch what happens, and their stock price is very important to them. Whereas if you're a fund manager and or hedge fund or any other major investor, you don't have those pressures. You're looking at returns. You're looking at returns against a benchmark, and those bonds were priced pretty well because they had to be. So therefore, they were, well oversubscribed.
I should know this, but and maybe it's in your printed sustainable finance goals. But is HSBC reducing its lending and aggregate risk profile
Yeah, it is.
in fossil fuels?
Yeah, it has been.
And is there like a target or something like that, or is it?
It's more of a glide path reduction.
So yeah, what else? I guess
Got to get to the witty manner. We haven't gotten there
we
yet.
really.
We're kind of destroying this for the
Maybe
attendees.
we'll open to questions later. And
Okay,
hope that
maybe
there's
hopefully they'll be
some
witty as well.
wags out there who can. Okay, so I'm interested in, I guess, the transformation within HSBC. At what point does the bank decide this is important?
Yeah, well, it has decided it's important.
No. I mean, at what point did the bank decide?
Oh.
And kind of, and what's the tipping point? Is it consumer, shareholder, your children say do the right thing? What is it? What is the
What's the catalyst, if you will? Yeah. Look, I think a couple of things. Being a global bank, you get to see the world like no other institutions. We're in 65 countries in a very meaningful way. And, I've traveled a lot of those countries. And so you get to see what works, what does not. You get to see the importance of the relevance that a bank can bring. And again, I don't think there's any CEO out here who says, I'm just going to, completely ignore the impact that my firm has. I'm going to completely ignore the good that I could do. And I think we felt as a firm that we can have a huge impact, very positive impact, and do so in a way that was still profitable. We didn't say we're going to have a sacrifice of profitability, but we thought that both for our employees, which was very important, and I think our employees have certainly rallied around the fact that we are a leader in this. I think for our clients who respect what we do, even the ones that we've had difficult conversations with. At the end of the day, I think if you're consistent to say, I'm sorry, we're not going to finance a certain project because it just runs afoul of what we want to do as a firm, they can only respect your principles as a company. I think for our other constituents, and as a bank, we have many. We have regulators, we have local politicians, we have all sorts. And then, yes, you're right, for our customers who are very mindful of this, And I've got a 25-year-old daughter, and she tells me all the time about what we should and should not do. She is very unvarnished in her criticism of what she feels that a bank like HSBC should do, and that it should be a provider of good versus a provider of bad.
So if your money is right, and you guys are rightly sort of ahead of your competitors, probably the gap narrows. I mean, every company is now a purpose company. Every company is sort of saying the right things at least. How do you differentiate yourself, and maybe what are some innovations that you've made in this space that you think set you apart?
Well, I think you're right. Look, I think green finance started more in Europe. European companies, European banks, European governments were far ahead of the United States. And I can tell you European regulators are. European regulators are now saying that they want all banks to stress test themselves for climate change over the next 30 years. Very difficult task, by the way. I don't know how we're going to do that, but the U.S. regulators, U.S. banks, U.S. Capital markets issuers were behind. That is starting to change, and I think you'll see the U.S. capital markets pick up quite a lot. So I think you're exactly right, and the U.S. banks have fully focused on it. So we have a lead, but it could be a narrowing lead. And I think it is all based on thought leadership. What is the next thing that you should think about? And we were an early signatory to a lot of things like the Equator Principles. And in that, you really have to go out and work with companies, work with issuers. And it's the thought leadership that you bring to that. So, for instance, if you have an issuer or a company, call it a natural resources company in India, they're not thinking about the Equator Principles, I can tell you. They're just thinking about building whatever plant they're building. And the ESG principles are not something that they think of. You have to be there, try to persuade them this is what they should do and what they should think about, despite the fact it's not necessarily going to be good for their bottom line. And we've done that. And it's been very, not only rewarding for us, but it's been very good for the project or for the issuer. So I think it's taking those type of learnings, applying it on a constant basis. I think one good example of that, what we're doing here with the Center of Business Sustainability in trying to define for the apparel industry what a positive ROI can be by sustainable investment. And it's trying to go to companies to say, you actually can make a positive return. And we're going to show you through very strong analytics that we're developing in tandem with NYU in the Stern School. And that's very powerful for, in particular, smaller companies who don't have that ability to do so. I mean, a large company maybe has figured it out. You mentioned Unilever. I think they figured it out quite early. Middle market, smaller company does not. And so that thought leadership, I think, will be very important. Thirdly, it's making this much more acceptable to smaller companies. So in the UK, for instance, green bonds, green loans are really for large companies. Most of the issuance have been for the very largest companies. So we lower the amount in terms of the threshold to allow much smaller companies to issue green loans, which we lent them that money. And we help them do it. We have frameworks to say this is what a green loan is, this is what you need to do. So we tried to take a lot of the friction costs out of that process. And I mentioned the supply chain financing. The importance there is that it gets deep into economies. So if you can think of all large companies, they have ecosystems that they build around them. Walmart is one of the largest, but General Motors is very large. I mean, every major company is quite large. If we can help their suppliers, and then the suppliers to their suppliers, really think about sustainable finance, because we are actually offering them a financial means to do so, and again, taking the friction cost out of that, that's huge. That's how you get the sort of the knock-on effects that we need to really change the way that not only large companies, but the entire, different levels of the economy think about it as well.
So I'm going to ask you one more question, then we'll open up to, this joke-a-thon cannot continue. And I think we're
I'm laughing. We want them over.
I think so. Yeah, I think so. So I guess this is a question that's really personal, and it's or philosophical. I don't know. I mean, I have a friend who works in the business who could well be here, who sort of says that it's not about green at this point, and his view is because we've lost so much time. There's been so much damage to the planet, and so difficult to get back. It's really about not black, is his metaphor. How optimistic are you, and can we continue to be when, for every step forward, it feels like there's a step back?
Well, look, I can only say from a financial or banking perspective, I think we are at a point of positive change. I really do. I think it was slow to get going. It was something that was real niche-y for a long time. It was a little corner of, every bank had these huge trading floors. It was one little small corner of the trading floor, on floor 5 back in the far west corner. There they were. But I think it's actually fundamentally changing, and I think the financial community is waking up. And the important things here is that the world depends on money. The world depends on capital. The world depends on any entrepreneur, even any large company, being able to raise financing. And if the switch occurs, and I do believe it will, where people really are incorporating all of these ESG, attributes and developments into how they think about running their business, it's hugely beneficial having the financial system going in that direction. The reverse of that, if the financial system wasn't even thinking about it, it would never happen. It would just never, ever happen, because you have to have a marriage of what the financial capital markets are thinking and what we're all thinking in terms of, the benefits for doing that. And so it is turning. Now, it is slow. It's a massive machine. I mean, last year there was $250 billion of green bonds issued. Sounds like a lot, $250 billion. It was 5% of the total bonds issued, just in the United States, by the way. There was about $170 billion worth of bonds issued, or bank loans issued. That's also about 10%. That's great. 35% apparently assets under management have some sort of green component to it. That's great, but you've got another 65% that don't. So it's making progress, and the rate of growth is very high, but clearly it needs to continue to grow. But I think all the mechanisms are being put in place. I think there's much greater sensitivity. You're having generational changes in companies. You're having certainly generational changes in the customer base of most companies. So it's not, I don't think it's ever turning back. To me, it's really the pace of change and what else can be done to make that accelerate.
And let's hope every CEO has a 25-year-old daughter who's paying attention.
That's right. They're the most persuasive.
So let's open to questions. I know there are microphones that people are running around with. Yes, there's a couple.
A couple quick points. One, I think that the uptake of ESG mandates is evolutionary, not revolutionary, as you alluded to.
Yep, correct.
Because we're going to have baby boomers aging out. We're going to have millennials, and that next gen are going to take the reins of companies and management. That's a key thing. Patience here works. Number two, investors are not monolithic. You've got institutional investors like corporate public pension funds that are different than foundation endowments, and they're people not only think, but others that are going to carry that mantle. And three, an observation. Maybe companies, corporate entities that are on those conference calls, quarterly conference calls, should get their investor relations people to start thinking about using language and questions that relate to ESG, so it's not just numbers. Just a thought.
No, it's a good point. And what we've done, we've bifurcated it now because we were giving a hard time people coming to the ESG roadshows. But we do now have just separate roadshows, and we go around and we say, for those interested, let's come talk about it. That's been helpful, at least, to get the message out. But actually, it's a good point to say, we're going to shift. We're going to talk about what we do. We'll see how it goes. It's still, those things, are they take a life of their own for those of us who listen to them. But it's actually a very good point, though.
Hi, Daniel Aronson from Valuetus. We work on the value of values. To follow up on that, I suppose this is a bit of a challenge, but what do you think about, rather than being reactive to investor questions, if this really is part of how a business generates value, answering questions about the business's value generation and including ESG?
I mean, it's somewhat of the same point. Look, I think we're getting there. It's a bold move to, ignore questions on your, returns or your balance sheet or your whatever. But I do think we have to change the language. And just the reporting, as the question was earlier posed, was helpful because I think people kind of demystified what they were thinking. Once the reporting and, this is what we're trying to do got out there, I think the next logical step is taking that language and really embedding it in everything we do. We've done it, I think, internally better than probably externally. But so we have to push that next button. And so we're going to need, the larger community, which is really the investment community as well, to be interested and hear it. But I think that's the direction we're all going in. Now, some are not. Some will not even mention it. Some industries don't want to talk about it, frankly. I get it, because it's a little more difficult for them. But, our firm, and I think this industry, is much more willing to get there.
Hi, Phil Clausen from Salter Baxter. So you mentioned the gap between the sustainable finance and sustainable issuance and the total. And there are other gaps also where companies are making big commitments, but then there's a light being shown on their advocacy efforts, which are maybe contrary to those commitments. So anything you can share about closing those gaps and trying to move the entire enterprise in a more sustainable direction rather than having this piece of it that you trumpet the great things and then the core of the business
Well, and it's
reversing
point. There's this topic or definition of greenwash, which I never heard of. What is greenwash? Well, greenwash is going out and saying you're doing a lot of things in the ESG space, but you're really not. Because again, there's definitionally such lack of precision and inability to interpret what really is a green financing. So what we've tried to do, we've created our own database, and we actually have PwC come in, and we have pretty strict definitions. I think that, one, that's what you have to go, and that could be something that certainly the agencies and investors and even SEC, I think that's kind of where we would like to go, to have here's definitions of what is green. You got to stick to that as a first step and have auditors actually audit that. I think that would be very important. I think, in terms of that closing the gap between total issuance, one, eventually we'll have to have some sort of price concessions. At the end of the day, that is important. Right now, there are some, as I mentioned, starting to occur in the loan space and some of the other spaces. In general, though, in the bond space, very little. Now, if Larry Fink and BlackRock only buy green type of investments, that's a big step. And that, I think, will usher in much greater issuance because there'll be a shortage of paper. And there are already, most sales desks will tell you today, if you go on the sell side, which banks are versus the buy side, will tell you there's more demand for green paper than there is supply. So that is actually good because that does produce the pricing concessions you need, and that then creates more issuance. And so the bucket will be filled if the demand is there. So this will be more demand-led than supplier-led, in my opinion.
We got time for, a couple more questions. Yep.
Thank you. You mentioned supply financing. Are you providing incentives for people to engage in greener supply chain management practices?
We are, yeah. And so in the Walmart program, which I mentioned, so they defined sort of transitional steps, and they had it, there's metrics behind it and such. And so we use them to determine which of their suppliers are making progress, and that's a transitional progress, which I think actually, by the way, is the most important aspect of this, is that we have to incentivize companies to make progress. You've got to go from high carbon, low carbon, or just improve your process. You can't just go to companies that are already green and say, hey, let's just issue green bonds. One, there's not that many of them. Two, it doesn't really create the right incentivization. So in this program, and again, this is smaller companies, and Walmart has a lot of them in terms of suppliers, by giving them the incentive, and which are through price concessions. So if it costs 100 basis points, we'll give you a 25 or 10 basis point break. It really incentivizes these companies because first it's Walmart asking them to do it, very powerful, and you're going to get paid to do it, even more powerful. So if you could see more of these programs being put in place, then I think that is very important, in particular for smaller companies, to jump on the bandwagon. Most of them, again, want to do it, but this is very powerful when your number one buyer tells you, do this, and by the way, we're going to pay you if you make progress. So.
Good time for,
Thank you. You mentioned sustainable finance. New York State just started banning single-use plastic bags, and along with 7 other states. The fact that you mentioned sustainable finance for HSBC, I don't know if HSBC is investing in those plastic companies, but if you do it, why you are continuing to do it? If you don't, then why you don't, and why would you like to encourage to other investors to not to do it?
Yeah, so to be honest, I don't know who makes the plastic bags. So, there's large chemical companies that make the polymers that make the plastic bags, is what it is. So, and that's part of the whole, what we report today. It's one of the 5 or 6 industries that we report. And, we are decreasing. Not all chemical companies make the polymers that make plastic bags. So so it's not that of of a simple ban on all chemical companies. I mean, everything in this room is made by, there's chemicals in it, so we don't want to go too crazy with that. Otherwise, it'd be difficult for us to go on with our daily lives. But look, I think that's perfectly fine. And I think there's, our stance is that we don't want to, do business with companies that cause a lot of pollution. Just not plastic bags. It's, other carbon, type of carbon pollution. It's other things that we have, taken a very active stance on, such as the energy policy, which meant, we don't do a lot of business with a lot of energy companies anymore, pipeline companies and others. So we're doing it on a very systematic basis. You've got to look at the whole industry and the ecosystem around that industry to try to figure out the best way to approach it.
So that question makes me think, in this sort of transitional moment, whether you think fossil fuel companies are adequately provisioning for the cost of decommissioning assets that will be stranded at some point.
It's a good question. I don't think we know. I do think that, there was a report by Oliver Wyman, which is quite good. You should read it. And, their whole view was that the biggest risk to the financial system and to banks is the transition cost. And those companies within those industries going through a transition, some will just not be able to make it. And I think they put the figure at $1 trillion. Now, who knows? That's one, very large amount, and two, you'd have to get into the detail. But I think it's going to be quite large. And whether it be some fossil-related companies, whether it be some, frankly, auto companies or auto parts supplier companies, I mean, every industry in some way or another will go through a transitional period. So I think what you'll see is that both the financial community and banks, et cetera, will have to take that into consideration. Some will take place over a small period of time, I mean, relatively small, say 5 years. Others could be 15, 20 years. So that'll be one of the largest, most important aspects of running risk in any sort type of financial institution, trying to figure out which companies will make it, which industries will make it, because you could take two views, for instance, on the auto industry. You could say, you know what, they'll get through it, the large ones will get through it, they'll all become electric vehicles in 10 years and it'll be fine. But you say, not all of them are going to make it. And then you have to go down again to their ecosystem and say, which of their part suppliers provide parts just to the current engine configurations that won't be able to make it, versus the battery suppliers, you'll say, you know what, that's probably a pretty good bet. They're going to make it. You have to go through every industry. Now, as I mentioned earlier, I think, at least in Europe, you have the regulators in Europe and the central banks coming together. They've actually formed an organization. It's Greening of Finance, I think is what they call it. And it's really designed to force the banks to take that into consideration over a long period of time. And I think what could occur, and for the non-bankers out there, I won't get into too much banker speak, but they will bring the cost of that into the way that we have to look at the cost of capital through the stress testing methodologies. I'll leave it at that, because otherwise it gets very, very wonky after a little bit. But what it'll force banks to do is reserve ourselves against those companies that we don't think will make it. And when you start reserving as a bank, that's where your own costs go up considerably, and that's what drives down your appetite to take this risk.
You want to name a few companies that you think won't make it?
I will not make it. Very good attempt.
Okay.
Always a journalist, those guys. You got to watch it every moment. That's what I've been told in my media training.
All right, we have time maybe for one more question? Yeah.
Hi, Eric Davis with Con Edison. Can you speak briefly about to what extent, if any, you are working to invest in or directly offset your company's global impact on energy use or what you use directly, data centers, buildings, et cetera?
Yeah, we're at 30% right now. We want to be 100% by 2030. So we have a pretty good glide path going on, including looking at external investments into alternative energy. So we're a big arranger and investor in probably some of your transactions in alternative energy, which is very important, by the way. The tax policy is very important in how this happens in finance. And so write all your congressmen, make sure every time they talk about taking it away, bad thing to do. A big part of the alternative finance, or finance to the alternative energy, has been driven by the tax code. Banks have been very big on this, and most of the big American banks are major investors in both solar and wind, primarily because they see a good benefit. And again, I think this is perfectly right. It's a positive way and an affirmative way to get the banks to lend and to provide capital. And so for Con Edison and all the other power companies, it's been great for them because they get a better cost of financing and capital. and they can then fulfill their mandates, and the banks can fulfill it as well. So we do it both our own internal operations, and we're, again, in 65 countries, so that's a lot. And some countries, you don't have a lot of alternatives, so we have to be very creative on how we do it. And so we do some offsets, as I mentioned. So.
Thank you.
So I think we're at the end of our time. We're all on borrowed time at this point. So believe it or not, that was not scripted. I know it's sort of very tight repartee, but it was all spontaneous.
It was funny. It was humorous. I'm sure you're all thinking this is the greatest thing that you've ever seen.
We'll probably take
it'll be on YouTube a little bit later on. I'm sure you'll watch it.
We're really testing material, and we'll take it on the road. And anyway, please join me in thanking Mike for a really great presentation.
Thank you so much, Addie, for being a terrific interviewer as always. And thank you, Mike, for being a terrific interviewee, and loved the wit and repartee. So thank you very much. Just sort of a few final thoughts, and then we get to go to drinks. First thought is I want to again thank our sponsors, HSBC, Glenmead, and Invest Industrial, for your support in making this possible. I want to thank our moderators and our speakers. I want to thank all of you for coming, and I want to thank Eliza, Alyssa, and Sophie, who organized this event and did a great job. So just a few quotes that I pulled out from today that I thought could focus the mind as we head off for alcohol and unfocus ourselves. First, setting the goal forces the plan. If your dreams don't scare you, they are not big enough. Every employee is someone's precious child. Our carbon footprint is the only thing that's free. You will reduce return if you do not invest in sustainability. In fact, we are not investing with one hand behind our back, we're adding a third hand. The world depends on capital, and there is more demand for green paper than supply. We must all become conscious capitalists. Okay, now I'm turning to me. Great words by everybody else. Working with each other to establish the business case is critical to scaling up as soon as possible, and this is the decisive decade for climate. If we don't make the change this decade, our children will pay the cost. And I will make another quote, which is, I have a 25-year-old daughter who is unvarnished in her criticism. Companies must be, I ad-libbed this a little bit, companies must be providers of good. And we must help companies be providers of good. Thank you for being part of the movement to design this next chapter of capitalism and working with Stern Center for Sustainable Business. Have a good evening.